Your alert goes off at 9:47 a.m. The stock you've had on your watch list for 3 weeks, the one you almost gave up on, just broke through resistance. Volume triples in under a minute. Your group chat lights up. Someone screenshots the chart with 3 fire emojis. Another trader you follow posts, "Called it" with a rocket. You buy, not all in, but enough that your hands are a little unsteady on the keyboard. The breakout looked perfect. That was the problem. 11 minutes later, the candle turns. Quietly at first, a small pullback, nothing to worry about. Then faster. Then it's back below the line you bought above. Your phone buzzes again. This time it's not an alert. It's just the number, red, falling, and the sick, familiar feeling of watching a decision you can't take back. You close the app. Not because you want to, because you can't watch it anymore. This has happened to almost everyone who has ever traded. Not once, repeatedly. And the reason it keeps happening isn't bad luck, and it isn't stupidity. It's that the moment felt too convincing to question. And that feeling was the trap itself. There's a name for what just happened to you. A false breakout. A bull trap. And once you understand the mechanics behind it, that sick feeling in your stomach starts to make a different kind of sense. Here's what almost nobody explains clearly. That breakout wasn't random, and it wasn't a coincidence that everyone saw it at the same time. Resistance levels aren't secret. Thousands of traders are watching the exact same line, waiting for the exact same signal. And that predictability is not a flaw in the system. For someone with enough size to move price, it's an opportunity. Picture the other side of your trade. A large holder needs to exit a big position, too big to sell quietly without crashing the price on their way out. So instead of selling into weakness, they do something more efficient. They push price just far enough to break the level everyone's watching. That single move triggers your alert. It triggers the group chat. It triggers stop losses on traders who were shorting. It manufactures a wave of buyers. Buyers who are, in that exact moment, the exit they needed. You didn't get in early on a breakout. You became the liquidity someone else was waiting for. Once that wave of buying is absorbed, there's no one left to hold the price up. It falls back through the level, fast, and from where you're standing, it looks exactly like a crash. But it isn't a crash. It's the machine finishing its job. This is the part that should genuinely unsettle you. The first move you see was never designed to inform you. It was designed to move you. And anything built to move a crowd on command is not something a crowd should trust at first glance. The same trap runs in reverse. Price breaks down through support, fear spreads through timelines and group chats, panicked selling floods in, and then it snaps right back up, leaving the sellers behind exactly the way the buyers were left behind here. Same psychology, same architecture. Different emotion used as the lever. This is why experienced traders talk about waiting, not out of caution for its own sake, but because the first candle after a big move tells you almost nothing on its own. What happens after? Whether the level holds, whether real buyers stay, whether the crowd that rushed in stays or flees. That's the only part that separates a real move from a manufactured one. So the real lesson isn't a chart pattern. It's a discipline. The next time something moves fast enough to make your pulse change, don't ask whether you should act. Ask who benefits if you act right now, at this exact moment, alongside everyone else who got the same alert you did. Think about how it actually spreads. It's never just your alert. It's the trading server you're in, 12 people posting the same chart within 90 seconds of each other. It's the influencer who built an audience by calling moves like this, posting before you've even finished reading the candle. It's the little green badge next to a ticker showing trending because volume just spiked, which only makes more people look, which only adds more volume, which makes the badge stay lit a little longer. None of that is a conspiracy. It's just how attention moves once a crowd starts watching the same 60 seconds of price action at the same time. And a crowd moving in perfect unison is the easiest crowd in the world to stand on the other side of. Markets don't punish people for being wrong. They punish people for being predictable. That 9:47 alert wasn't bad luck. It was bait. And the only real defense is learning to recognize the shape of the trap before your hands are already on the keyboard.